We're waiting on any news out of China and the U.S. Of course, we know that the deadline is this Sunday. Beijing says today that it is hoping to make a deal with the United States soon that will satisfy both sides. This is the major deadline looms. Another round of U.S. tariffs on Chinese imports is set to kick in on Sunday, December 15th, less than a week. Joining us right now is Wilmington Trust Chief Economist, Senior Investment Strategist Luke Tilley. And Luke, it's good to have you. Thanks so much for being here.
Thanks for having me.
We're talking about a wildly busy next 2 weeks right here. So give us your sense of what it would mean for the economy if, number one, the deadline comes and goes and those tariffs go into effect on the 15th, and number two, USMCA comes to the floor the next 2 weeks.
Yeah, we don't think that the tariffs are going to come into effect, but if they did come into effect, we do think that would hurt the U.S. consumer a little bit more. Clearly, the previous tariffs have hurt the manufacturing sector and CapEx, but the next round of tariffs would fall a little bit more heavily on the consumer. We don't think that they are going to come into effect.
You think there'll be a phase one deal?
We think that there'll be some sort of deal, at least to push the tariffs off and not come into effect on December 15th, which, of course, would help the U.S. consumer, the driving force behind the economy, and also help that job growth that we saw this past Friday.
How about USMCA? How important is that?
It's important to get an update of that deal and also give some confidence to businesses that they can deploy CapEx and you can get more investment in the economy. Of course, that's been the weaker part of the economy over the past 2 quarters, and we think that that would go a long way to helping business confidence and CapEx in general.
So once again, it's the consumer, Dagan. That's the critical piece of this right here.
Indeed, in terms of the economy, but I'll point to a story on the front page of the Wall Street Journal today that, speaking of individual investors, they've pulled money out of stock, mutual funds, and exchange-traded funds this year at the biggest pace, the biggest withdrawal on record, going back to 1992 when Lipper first started tracking this data. $135.5 billion pulled out of U.S. stock-focused funds and ETFs, despite the fact that the S&P is having its best run since 2013. Is this actually a good sign that people aren't chasing returns, or is this a point of concern?
It could be a point of concern, but I think that ultimately what's really going to drive it is how the economy does, because that's really going to drive earnings and consumer behavior. So it's not unusual for consumers and investors to get a little bit more nervous about markets when you get this late into a recovery. But our view at Wilmington Trust is that the recovery will continue as we head into 2020, and that's going to end up helping markets.
Was anybody struck this weekend looking at all the Sunday shows that Sunday Morning Futures was the only Sunday morning program to mention the blowout jobs numbers that we saw on Friday? I mean, it's pretty incredible that the impeachment story has taken the oxygen out of the room in every room, but there were blowout numbers on Friday on the economy. The only indicator of strong economic backdrop for the first time in U.S. history. A decade has passed without the country falling into a recession.
And with that, Luke, it seems the Fed is on the sidelines and it's about the economy. So could we really be set up for an extended recovery? And the R word for recession is really pushed back. So that the strength of the U.S. economy, even aside with China trade, looks to be pretty good for next year.
Yeah, we think so. As you point out, Maria, the job growth number is really strong, even when you net out the impact from GM. And we do have the longest recovery on record here. And we think that it really comes back to productivity. Companies that have been investing so much in their ability for their employees to put out more, all of that CapEx. What that does is it gives companies the ability to keep producing without a significant amount of wage pressure and not putting through a lot of price pressures. To your point, if you don't get significant price pressures from those companies, then the Fed can be on hold and we can have this recovery.
Quick question,
continue.
Would you stay long with the U.S. market or look to invest outside the U.S.?
We're neutral to the U.S. right now, but we're optimistic that things will improve. Just a couple of months ago, we moved back into international developed, and really that's a story, an optimistic story about global growth overall.
But if things
equities.
are so great, what about the story Dagan refers to in the Journal today? Investors are bailing on stocks.
Well, we don't think that that's necessarily the best guide. Clearly, individual investors sometimes are going to get a little bit more nervous. As I said, when you get this far into a recovery, there's going to be some nerves, but we think that the outlook is positive for 2020.
And on the flip side, you very often at the end of a run, you will see mania. You'll see hysteria about, I got to get in, I got to get in. You're not seeing that.
Which
so
I
you
like.
Look at this as a counter.
We're not at the top.
Yeah, that's why I said to you earlier, it's a contrarian.
Absolutely.
Yeah. All right, Luke, it's great to have you. Thanks so much. Luke Tilley joining us there.